Hello and welcome to this Thursday's morning market briefing. We've got lots to talk about, but firstly, stocks drop as ECB and UK inflation puncture interest rate cut hopes, as well as that China's population decline accelerates as economy reaches low growth target. We've got lots to talk about on the charts. Also, we've got lots to talk about on the economic calendar as well. But we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it, though, make sure to subscribe. The first article to talk about, of course, is stocks dropping. Now, stocks and bonds dropped yesterday following new UK and Eurozone inflation data. This saw investors retreating on their initial expectations of rate cuts beginning March. Now, we've obviously been talking about, where rate levels are at the moment, interest rates at the moment, and we've obviously been highlighting when they might first be cut. And ultimately, most recently, I think, investors have brought closer and closer those expectations for when rates were to be cut. And I think, this kind of began first with the Eurozone and the ECB after we did see the poor performance within the Eurozone economy, and especially Germany, where obviously they were highly affected by the Russian sanctions, or by the sanctions on Russia, and how that's affected oil and gas prices, and how that's weighed on their manufacturing industries. And that's added greatly to that producer price inflation level, and thus added to consumer levels of inflation. And also the drop in demand as a result of those higher interest rates have also weighed on businesses in the Eurozone as well. Therefore, we were seeing that lack of growth within the ECB, and we were in fact seeing lower levels of inflation than were previously expected. So we did think that it was logical for the ECB to start cutting rates soon. And the date that was kind of devised by the markets, it did seem, was March, and this then extended over to the Fed as well, after we did hear that more dovish tone from Jerome Powell ending off last year, where we did hear his kind of rhetoric around inflation being on the downside, and whilst they weren't talking about when rates were to be cut just yet, they were talking about there being more of a downside potential for cutting rates rather than raising rates further, which added to this more dovish message that's added to these expectations of a March rate cut. On the other hand, for the UK, I think the expectations have remained rather hawkish. I know that most of the expectations are still for summer rate cuts for the UK, unlike what we've heard with the ECB and Fed, as ultimately the UK has been battling with a far higher, greater inflation attack, almost not attack, but issue, as UK inflation did reach over 10% last year, and it stayed at those significant levels. And those levels that we did see in yesterday's market release is something to note, of course, and that's why this article is so important to kind of note, is because understanding when these rate cuts will be implemented by their respective central bank will weigh greatly on the way that certain FX pairs will move within the market. Of course, if we're expecting the ECB to cut rates before the UK, then we can weigh on the fact that the UK pound is going to perform better than the euro, as ultimately investors will be able to hold on to that higher level of interest for longer than we might see with the ECB. And that's why we see then the UK's pound then go up in value, and that's why we have to keep a close eye on these topics, as if we're now seeing new data being released which is highlighting those initial predictions to be wrong, we could then see a walk back of certain gains made by certain pairs, whilst investors priced in these expectations. Now, the ECB's President Christine Lagarde signalled that cuts would begin in summer. Along with that, in Britain, they saw their first rise in inflation in 10 months, highlighting underlying price pressures, with Lagarde saying the expectations for an early rate cut was not helping bringing inflation down, as many investors may price this in, start investing in certain assets, which then help push inflation higher or keep it higher for longer. And this is what Jerome Powell was trying to fix kind of when we were ending off last year, was because we were hearing these kind of early rate cut predictions come out from US investors, and Jerome Powell was trying to calm the markets by coming to them and saying, look, we need to wait for more data and this sort of thing, and that we're not talking about rate cuts just yet. And despite that, he ended up adding a dovish tone anyway, which has weighed on the markets still today. But ultimately, this is what we are seeing, is when we do start to see investors kind of predict those rate cuts to be very soon, we then do see the market like kind of take a hit and these inflation issues be worsened. Now, British and Eurozone equities closed down on the day with the FTSE 100 down 1.5% on the day, with the stocks also closing down 1.2% lower. It was overall a very hawkish picture presented worldwide, with the US retail sales data also weighing on expectations of early rate cuts by the Fed. Now, this saw the S&P down 0.6% by midday, and the Nasdaq down 0.9% as well. For Britain, inflation rose to 4%, leading investors and traders to push back the dates for the Bank of England's rate cuts. And this is despite, of course, those rate cuts being expected far later than the ECB's and the Fed's. Now, this figure represented the first rise in UK's inflation since February 2023, and that's very significant to note. But we have also seen this in the Fed, in the USA and the Eurozone recently, and this is all as a result of fuel subsidies and other things in relation to kind of energy and fuel. Now, President Lagarde did, however, say she was confident inflation would reach its 2% target, and that is kind of the bit of dovish messaging that we did hear from her. She did, however, warn inflation was still too high in the labour-intensive sector. But that's a very important topic to stay on top of. We'll make sure to continue to revisit these kind of topics in relation to inflation and interest rates. But of course, we need to move on to the next article, with the next article being around China. Now, China's population decline accelerated in 2023, whilst its economy grew at its slowest rate. This continues to add to the growing picture that China is facing large economic problems. Now, obviously, we've been talking a lot about China, not only in relation to its economy, but of course in relation to its world tensions. And this has been weighing on certain assets, such as gold, with Taiwan's elections recently weighing on gold's prices and driving gold's prices upwards, as we did see the DPP win that election, which has a more anti-China, anti-CCP tone to their policies, and therefore kind of increase the risks basically of an escalation to a conflict on the Taiwanese Strait. And so that's why we are kind of seeing issues in relation to that on the charts. But ultimately, this article mainly focuses on the Chinese economy, which of course we've also been talking about a lot, with China struggling greatly at the moment with their economy, and especially their property sector, which has been kind of dealing with this debt crisis now for nearly 3 years, and has constantly been revisiting it. We've kind of constantly been revisiting it as well, with us highlighting, of course, the underlying structural issues within the Chinese economy at the moment, which is keeping growth lower than previously expected. And ultimately, China's zero COVID policy obviously did, of course, weigh on the levels of growth that we did see coming out out of the COVID period. Now, GDP grew by 5.2% last year, coming in above the 3% figure seen in 2022. However, the population dropped for the second year in a row, with births declining. Following the data release, Chinese equities fell, with the Hang Seng in China Enterprises Index shedding 3.5% to be down 9% on the month. The CSI 300 index also fell 1.1%. The damaged property sector, which is still dealing with a debt crisis, continued to suffer in 2023, with investment in property development falling 9.6% last year. As for China's population, 11 million deaths outweighed the 9 million births, with China's population falling to 1.4 billion in 2023. And we have to imagine how this might affect the politics within China, the foreign policy decisions by China, and also the economic decisions by China, of course. Now, the population declined for the first time in 60 years in 2022 following COVID, with these declines being the result of the instituted one child policy implemented in the 1980s. The national death rate was 7.87%. Sorry, I'm really messing up my words. 7.87 per 1,000 in 2023, which is the highest since the 70s. So this is very important to stay on top of. Keep your eyes on news relating to China, as the issues with its economy at the moment are very interesting to note, as well as the world tensions which are being kind of raised by China's influence with Taiwan, obviously being of interest as well. So keep your eyes on all of that. Next to talk about, of course, is the markets and the charts. To begin with, of course, the US 30 is to talk about. Now, on the US 30, yesterday we did highlight how recently the US 30 has kind of been ranging around, moving from, up to down, and ultimately has been interacting with these two liquidity levels quite a bit. And this has been representing a strong area of support on the downside and a strong area of resistance on the upside. Ultimately, though, these are the highs that the US 30 is sitting at, as it did push above and break above its all-time highs as we did end off last year in December. And this has largely been driven, of course, by the recent dovish rhetoric that we have heard from the Fed, as we spoke about near the start, but the added dovish messaging we did hear from Jerome Powell as we did end of the year did drive the US 30 and other US indexes to its highs. And currently we've not found any momentum to continue that push higher. And ultimately, we are continuing to range around, and we're not moving to the upside or downside. But definitely keep your eyes on the US 30, as we are currently interacting with this key support and liquidity zone, but we have not broken to the downside completely just yet, nor have we kind of pushed back up and continued in the range. Sorry about that pause. I thought we weren't recording and I got really worried there for a second, but we are recording. Brilliant. But next to talk about, of course, is the dollar, which is in an interesting position because it has now broken above that range that it's been sitting in for quite some time. And this is what we highlighted in yesterday's morning market briefing, is the fact that it has finally broken out of there. And this was largely driven by, I think it was certain Euro news yesterday, but ultimately we have now seen the dollar be driven to the upside. What will be interesting to see, though, is whether we will reach that minus 27.2% Fibonacci extension level, or in fact we will retrace to that liquidity zone that price has been interacting with whilst it was ranging, and then we'll see a continuation to the upside. So that will be the interesting thing to watch, and depending on that we can then judge where the dollar may go in the future. Next, talk about, though, still on top of the dollar though, is Euro USD, which is important to talk about, considering what we did talk about with the ECB at the start, with President Lagarde's kind of messages yesterday weighing on the way Euro USD did move. But ultimately we did kind of push lower, but we are now seeing that kind of bullish return to the upside. Possibly now we'll be able to retrace to the upside before continuing to the downside. So that will be an interesting situation to see unfold, as ultimately I have drawn out this Fibonacci retracement tool just here, And there are some very interesting levels which price may interact with. So keep your eyes on that for sure. Next to talk about though is pound yen, which has continued to push to the upside. We did highlight yesterday how price had interacted with that kind of short-term 50% Fibonacci retracement zone and had moved to the upside since then, but was interacting with this kind of double top level. We weren't sure whether price was going to continue to the upside, but as we can see, yesterday's session did allow pound yen to push further higher and has now neared its all-time highs. So we are now sitting around that 188.0 level. So definitely keep your eyes on how pound yen moves over the next few days, as this could be termed as a very large liquidity and resistance zone, just because it is the kind of most recent highs for many years. So how we interact with this zone will be very interesting to see. Keep your eyes on that. Next to talk about though is Bitcoin, where there isn't really too much to talk about. Obviously, we did see that sell-off following the SEC's approval of Bitcoin ETFs, but currently we're just sitting around this lower level of liquidity that price has interacted with before, but we haven't seen any significant moves just yet away from that. But what will be interesting to see though is whether we now just kind of return back into this range, which we did see price interact with and stay within for quite some time. So whether we do now kind of move to the upside and interact with that resistance level, it will be very interesting to see. So definitely keep your eyes on Bitcoin. Whilst we are kind of seeing a lack of momentum at the moment, there are some interesting levels which price may interact with. So keep your eyes on that. Next to talk about though is gold, which did see a significant sell-off yesterday, as ultimately messages from these key central banks around inflation still being too high is driving a more hawkish message home to many of these investors and traders, and as a result we're seeing a sell-off in gold, which is often used as an inflation hedge. And that's why we're seeing that sell-off, is because investors are now pricing in rates staying higher for longer in comparison to those previous expectations of rates being cut as early as March. We are now seeing that sell-off as a result. That said, we do have some opportunities opening up for gold to the upside if we do see world tensions raise further, as escalations in all these conflict zones at the moment, such as Ukraine, the Middle East and Taiwan, obviously create a very upside potential area for gold always, as if we do see those escalations, it's likely that gold will go up as well. So keep your eyes on all of that. Lastly to talk about though is oil, which did break below this kind of short-term counter trend line to the upside that we have seen form recently, but we have now broken below that but then returned to the upside. So maybe this was a false breakout, or in fact it's signaling that price is to go lower now, as if we just kind of adjust that trend line, very easily we could say that price is still kind of in this counter trend line. And ultimately how price has been reacting to this key liquidity zone, I think, is the most important thing to keep your eyes on. So keep your eyes on gold not only but also oil. Lastly to talk about, of course though, is the economic calendar, where we are getting lots of data today, and very significant data indeed. To begin with though, we are getting Aussie unemployment rate figure, as well as the Japanese industrial production figure. Along with that, we're getting Spanish balance of trade figure and a Swiss central bank official's speech today. Finally, we will be getting the ECB's monetary policy meeting accounts, along with the US building permits data and continuing jobless claims data. As well as that, we're having the ECB President Lagarde speaking once again in another speech, with numerous Fed officials also speaking in their own speeches. And finally, we will be getting the Japanese inflation rate to listen out for. So lots to talk about that we've covered today. Lots on the articles, lots on the charts, and lots on the economic calendar as well that we've covered. I hope you have a great trading day, but that's all from us at Wildwood Capital. Have a great one. See you later.